Welcome to CrushTheStreet.com's Weekly Market Wrap-Up. We'll start things off in the equity sector, which of course had a truncated week of trading due to the ravaging effects of Hurricane Sandy. The markets were closed for the first 2 days and opened Wednesday with an understandably lackluster performance. However, yesterday's surge in the major indexes took many traders by surprise, with the highlight being the triple-digit jump in the Dow Jones. According to CNBC, the bullish momentum was attributed to better-than-expected ISM manufacturing data, increased performance in European equity markets, higher consumer confidence, and a reduction in jobless claims. The most anticipated data source, however, is the U.S. Labor Department's jobs report, and speculation is running wild ahead of its release. The surprising gains in the equity sector led to benefits for the paper bulls as the U.S. dollar index again took a crack at the 80 level, this time closing a hair above that key support line. Fundamentally, in the near term, the dollar could lounge around the lower 80s as uncertainties regarding the economic damage inflicted by the hurricane could cause investors to regard the greenback as a safe haven asset. From a technical perspective, the dollar has a long way to go if it were to spark a sustainable rally. The 50-day moving average is below the 200, suggesting that the longer-term trend is down and it would need to rise above the 80-60 level where the 200 DMA currently sits in order for the paper bulls to convince me that this is nothing more than the random death throes of a terminally ill dollar. Let's talk about the precious metals, starting with gold, which took a slight dip on Thursday's session, but the more important point is that the yellow metal is sitting above the critical 1700 level after 3 weeks of decline. Clearly, the bears have lost some of their downside momentum, and the technical indicators are suggesting a possible reversal to come soon. And by soon, I mean sometime within the next 2 or 3 weeks, and not some vague, indefinite time in the future until the prediction rings true. For gold, the downside is minimal, as I believe there are 2 distinct lines of support. The first line is where the price action currently sits, and I expect a rally to develop somewhere along this point. If this support is violated, the second support line should hold it above the upper 1600 range. However, the big resistance level is the 1800 price point. I forecast that we'll break it within December, but this will be the battle to watch. Finally, let's discuss silver, which was relatively unchanged from the prior session. The key, of course, is that it's trading above the $32 threshold, and while we could see some choppy action in the days ahead, the technical indicators also suggest that a reversal is on the horizon. Taking a look at a broader picture, I believe that there are 2 lines of both support and resistance. During QE3, when silver failed to clear $35, it eventually fell underneath the main resistance line, which was initially acting as support. The silver bull's first job is to take out the secondary resistance line, which currently is represented by the 3250 level. I believe that this will come shortly, perhaps by the middle of next week, and I also think that the 3150 was the bottom of this correction. Here are the downside risks. If the dollar unexpectedly rallies for a lengthy period, the first line of support is at 31 even. If that fails, the second line of support is at 30. If we fall below that, I see a quick trip to 28. However, I consider that to be a low probability event, and this week and next should be great buying opportunities. And that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CrushTheStreet.com.